Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Okay, so I'm going to try to walk through really briefly, God help me, through this gentleman, David Rogers Webb. I've been thinking about David's presentation and looked at a couple different things from him. Probably the best way that you can find some of his information there is a free PDF book that he's put out. They also have a YouTube channel now, which I think is much easier to kind of grasp what they're talking about. It's called The Great Taking, so you can see that's the name of David's book, The Great Taking, and the YouTube channel is by the same name. The nice thing about the YouTube documentary, we'll call it, is that they flash up on the screen a lot of the like court or documents that they're referencing as he's talking. So they kind of do a screen capture or something like that over as he's talking. It's really nice. So, okay, David's position is not easy, and there's a couple pieces that you have to sort of believe. I think almost you have to take him on faith at a certain point, which is challenging. It's best if you have to take him on faith at as little points or to the lowest extent as possible. And so in this video, we're going to be kind of rehashing some of the 2007-2008 banking crises. David's whole book is essentially a hypothetical analysis of what happens if you have a major problem in the financial markets, some kind of sweeping insolvency. For David's driving point, he's really talking about do we own our shares? Do we personally, especially in the event of an insolvency, let's just say that I use Fidelity, for example, as my brokerage. What happens? What happens if they become insolvent and go bankrupt? We looked last time in my last video about an example we saw from Rob Berger, I believe his name was. Great guy, lawyer. And he said basically, look, there's no problem because behind, say in his example, he used Schwab as his example, which is a brokerage if you're not familiar with that. And all I mean by brokerage is a place where you can buy and sell financial products like stocks or ETFs or CDs or options. What happens if this Schwab in this example goes bust? Rob basically said, yeah, well, behind those institutions is what we call a custodian. Custodian is a large bank. In the case of Schwab, it was State Street, a huge bank. And so essentially the idea was, well, this is a huge bank. They're well capitalized. Probably also there's insurance. There are insurance products that are bought by brokerages. I've looked at this before. I don't have that information for you today, but you can Google that and find, the precautions that they take in order to secure, improve the trust and secure the assets of their clients. Okay, all that, this is a bunch of words, but basically David Rogers Webb says there's nothing there. There's nothing behind it because David continues to push, and he says, well, what's behind the custodians? What's behind State Street? And if I could just make it very simple, it's that when I buy a share, I don't own that share personally. There's no personal identification number on that exact share, like say of Apple that I bought, and I'm interacting with a clearinghouse. So there's all the assets that we all buy and sell, they're all cleared through a clearinghouse, meaning they're like the person on the other side of the transaction. You could say it like that. And so really I'm dependent upon their solvency. They're my counterparty. They're your counterparty. They're the counterparty of the institution that holds your pension or your 401k or your Roth or whatever. They're on the other side of those assets. And so David's second point is you can't identify your personal shares. You're interacting with a counterparty, and if the counterparty becomes insolvent, then what? Who's behind the clearinghouse? We'll say, and David basically says no one. And what's worse than that is that shareholders do not have priority claim to the assets, whatever residual assets can be arrived at. It's something like larger institutions, maybe the State Street, maybe the JP Morgan, but some larger bank institutions have a priority claim to protect them before I'm protected. And David always talks about that individual shareholders like you and I, we have a junior or subordinated claim and it's pro rata, meaning that it just means that basically whatever's left over after the first people get paid out, we get paid out last, and we all have to divide up whatever is left over. Meaning that we're not going to get 100 cents on the dollar. We're not going to be made whole. That's the whole problem. I was, sort of down and somber last week after trying to get through his information, and just because it hits you when you first come across it, you think, oh man, it's really tough to deal with. So what I want to try to do here, I think, to try to grab hold of what David is really trying to get at is, you have to believe in a large-scale insolvency. And a lot of his book, which you can get for free, or you can look at the documentary that they put together, which also references a lot of these same legal documents from the Fed, different statements that are made. They're not easy. I'm not a bankruptcy lawyer. You're probably not a bankruptcy lawyer. You're not familiar with international law, and some of this stuff is still not completely decided upon. Ultimately, what it means is that your assets are not, according to David Webb's perspective, our assets are not going to be protected. That's the simplest way to say it. And if you want to go all the way to the conclusion of the book is something like, it took a massive crisis. It took a massive crisis basically to close a lot of the banks and to form the Federal Reserve banking system. He thinks that's what this is basically all about. He doesn't think that rich people need to get richer and that they're not trying to get richer. He thinks that it's essentially about entering into a brand new system, which would be central bank digital currency system that would have a lot of control behind it. And you can find other information on that in other places. I'm not going to describe, all the ramifications of all of us joining on into a central bank digital currency system. But I will say that it seems like most people aren't going to do that just willingly. They're going to be forced into it, and that's essentially what David thinks this is about. It's a big power grab, and what they need to do is to essentially remove all competition and force us into this new system. Now, in order to do that, he believes that and he argues for a intentional breaking of the financial system. So he talks about it from the system of a great amount of leverage in the system, which we already showed last time. The derivative structure, which I'm going to try to show you how much money is probably in the derivatives complex. Most of the time, I'm going to be rehashing Leman Brothers, Bear Stearns, and Merrill Lynch, because in the last video that I did, it looked like we only really had Washington Mutual failing, according to the FDIC. Obviously, we know that's not true. Why isn't Lehman, Merrill, and Bear Stearns included in that 2007, 2008 numbers? So let's just get started, I guess, because the reason I want to start there is that in order for David's thesis to be right, you have to believe that you have an insolvent system, right? That's important. So let's start looking at commercial real estate. We looked at this last time. 2024, there's a lot of people in commercial real estate that are talking about problems with the number of maturities that are coming due. It's 28% more than 2023. It's a huge number. It's almost $1 trillion. It's the $1 trillion line. It's almost $1 trillion. If that needs to be, reissued or restructured at current rates, say a lot of people are going to get fixed rates somewhere around 8%. Floating rate debt might be 8 to 12, something in that range. So it could be a big problem. Also, with interest rates being elevated for extended period of time, you get into a situation where properties are not as valuable as they were because they're so heavily dependent upon interest rates. It's a sector that's heavily dependent upon interest rates, and your ability to make money on an office property depends upon the costs associated with getting the keys to the building, right? The expense on the debt goes onto your income statement and it reduces your profits. So if a building is not as profitable, it's not worth as much. I mean, that's one way to look at it. The other way to look at it is comparables. So you could look at comps, and if there's two identical buildings on two different sides of the same street, say in downtown, and they both were bought 20 years ago for the same price, and they basically are still at that price. If one of them sells for a 40% haircut, that's going to affect the one across the street for sure, and it's going to be repriced. It should be. So this is one of the problems, one of the potential areas of a market collapse was a lot of commercial real estate bankruptcies. Obviously 2007, 2008, here's a graph of that. 2007, 2008 had in the pinks, these are a number of bankruptcies, and you saw it's 152, large number. I mean, almost 500 banks between about a 5-year period. 5-6 year period. So a lot of banks failed, obviously related to the problem in the residential housing market in the United States, and that did have ripple effects throughout the broader economy and then international global economy as well. Okay, well, if you go on to the Fed's website, not the Fed's, I'm sorry, the FDIC, we see a list of here are the 7 largest bank failures, and you'll see on the right this is by assets. You have Washington Mutual, number 1 spot at $307 billion. Then the next 3 were all in 2023. So last year, when we had elevated interest rates, we had some pretty big bank failures. And so you come up with this graph, and you see this blue line under 2028 that this was the 308 by Washington Mutual, and then you see 2023 was much larger, like 550 billion. Excuse me if I was saying trillion, but these are in billions, these losses in the bank failures. So, but I was thinking, yeah, well, what in the world? Because there's more than just like Washington Mutual in 2008. I mean, so let's go back and remember Bear Stearns. Here's just the market capitalization, Bear Stearns 2007. So Bear Stearns seemed to be riding high with stock market capitalization of $20 billion in 2008. So market capitalization just basically means the value of all their equity. So it's what's their shares trading at, what are their shares trading at, and multiply that by the number of shares outstanding. So common stock outstanding will give you your market capitalization. So it's essentially, if we go a little bit further, I want to see what their assets were. So this says through a major subsidiary, Bear Stearns Securities Corporation, it conducted global clearing services to broker-dealers and professional traders and was a major security lender. So that's some of the stuff that David Rogers Webb is talking about. Clearing services, going bust, organizations that lend securities. It says by year-end 2007, its balance sheet showed $395 billion in assets, supported by $11.1 billion in equity. So before we move on, well, I guess we'll just finish reading. A leverage ratio of 36-1. Okay, so first of all, balance sheet showed $395 billion in assets. Well, what happened to our graph? Why didn't that make the graph? It's not on there. Maybe because they were bought out, and so I think that's the reason. But that's one thing to know, is $395 billion is a huge number. Okay. And the other thing to notice is that they're leveraged 36-1. So how much are these current banks leveraged? I mean, 36 times is... It's a lot. It's a lot, This is from Investopedia. With insufficient liquidity to open its doors, Bear Stearns approached the Federal Reserve Bank of New York for a cash loan of $25 billion. When that was denied, J.P. Morgan Chase agreed to buy Bear Stearns for $2 a share, with the Federal Reserve guaranteeing $30 billion in mortgage-backed securities. The final price was ultimately raised to $10 a share, a sharp drop for a company that had traded at $170 a year earlier. Now, this is what's really interesting, because these toxic assets don't just go away. Listen to this. Jamie Dimon, the CEO of JP Morgan Chase, would later regret the decision, saying it cost the company several billion to close out the failing trades and settle litigations against Bear Stearns. Under normal circumstances, the price we ultimately paid for Bear Stearns would have been considered low, he wrote in his 2008 letter to shareholders. The reason Bear Stearns was sold off so cheaply is that at the time, no one knew which banks held toxic assets or how big of a hole these seemingly innocuous synthetic products could knock in a balance sheet. We were not buying a house, we were buying a house on fire. So it didn't work. It didn't really work out for, even though they got it for, let's say they got it for $10 a share. It was trading $170 prior to that. They got it for, 5 cents on the dollar, let's say, 6 cents on the dollar. It was a bad deal. It was a bad deal. Like, it still was very difficult for them to, even being who they are, JP Morgan, it was still very difficult for them to be able to assess the actual losses of highly leveraged and complex derivatives products. And ultimately, who's more sophisticated than them? And they regretted buying it. It was a bad buy. They paid too much, like 95% off, right? And they still overpaid. So it means it was like literally worth zero, less than zero maybe. So lead up to the failure, increasing exposure to subprime mortgages. By November 6th, the company had total capital of approximately $66.7 billion. And total assets of $350 billion, according to the April 2005 issue of Institutional Investor magazine. Bear Stearns was the seventh largest securities firm in terms of total capital. A year later, Bear Stearns had notional contract amounts of approximately $13.4 trillion in derivatives, financial instruments, of which $1.8 trillion were listed futures and options contracts. In addition, Bear Stearns was carrying more than $28 billion in Level 3 assets on its books at the end of fiscal 2007 versus a net equity position of only $11.1 billion. This $11.1 billion supported $395 billion in assets, which means a leverage ratio of 35.6 to 1. The highly leveraged balance sheet, consisting of many illiquid and potentially worthless assets, led to the rapid diminution of investor and lender confidence, which finally evaporated as Bear was forced to call the New York Fed to stave off the looming cascade of counterparty risk, which would ensue from the forced liquidation. So this is, extremely interesting, and it didn't make it. It didn't make it onto this list of failed institutions on the FDIC's website because of the buyout, right? But still, there's huge risk there, and even if it's bought up by another bank, it's not good. So Leman Brothers actually goes bankrupt. Let's look at them. So this was just a Google search. What was Leman Brothers' market cap before the crash? This raises the broader question of how a 160-year-old financial institution, the fourth largest investment bank in the United States, holding $639 billion of assets and $613 billion of liabilities with a market cap of around $45 billion, could collapse abruptly over a weekend. So, $639 billion of assets. See, the reason I'm referring to this is because when we looked at this last time, I kind of concluded, well, the FDIC could basically handle a $2 trillion commercial real estate debacle. Like, they could basically clean up $2 trillion worth of bank assets based on the calculations I did, using how much they paid to clean up the Silicon Valley Bank and Signature Bank mess. They paid about 5.75% of the $330 billion dollar mess. And so it only cost them like $18 billion to clean that up. The reason was because most of the assets in Silicon Valley Bank were not insured assets. It was like 85% is what we found were above the amount covered by the FDIC. So FDIC cut off at $250,000 per account. And, there's a lot of wealthy people with large sums of money, investors, with money in that bank. I mean, FDIC wasn't going to cover that money. So I'm just saying, well, if the FDIC can cover basically a $2 trillion problem, and we only have short of $1 trillion coming due in commercial real estate maturities in 2024, even if that's a huge problem and some banks do go down, it's like I was arguing. I mean, we still got some margin. We got some overhead to work with. We just cleaned up $550 billion of messes in 2023. I mean, it's not like the lights went off is what I said, we didn't have mass unemployment. There was no utility grid shut down life basically went on and we were able to, it made headlines, but people, kept buying stuff and going to the gas station, things like that. Well, the point I'm trying to make is that obviously 2007, 2008 was a global mess. It was a huge problem. I mean, we did have huge spikes in gas, and there were a lot of problems during those years. And what I'm showing is that there were a lot more bank failures than what we saw in our last video. So we had Washington Mutual 308, but here Leman was 640 billion in assets. So let's just round that up to an even trillion between Washington Mutual and Leman, and then we got to add on Bear Stearns. Bear Stearns, they had another, we'll call it $400 billion in assets, so that takes us to 1.4 trillion. And then if I fast forward, I want to continue reading about Leman, but if I go to Merrill Lynch, they had assets 2006 of $841 billion. So before we were at 1.4 trillion, you tack on another 840 billion, 2.24 trillion, 2.2 trillion, sorry. 2.2 trillion is the type of mess that we had in 2007, 2008. So that would be above the limit of what we calculated last time for the FDIC. Just saying what the FDIC could cover. So real quick, let's go back and wrap up Leman Brothers before we dive into Merrill. But Leman Brothers goes bankrupt. No one buys them. Leman Brothers was considered one of the major players in the global banking and financial services industries. At the time of its bankruptcy filing, Leman held some $600 billion in assets diversified globally and was the fourth largest investment firm in the United States. It invested heavily in mortgage origination in the United States from 1996 to 2006, in large part by utilizing leverage, at its peak at a ratio of 30 times to 1, which was actually less than some of these other banks. As such, some say the firm became a de facto real estate hedge fund. When real estate values peaked and began to falter between 2007 and 2008, Leman Brothers became especially vulnerable. So there's the kind of write-up on that. And then what happened in the back end from Reuters, unsecured creditors recovered $9.4 billion, about 41 cents on the dollar. They were originally expected to recover about 20 cents on the dollar. Leman Brothers Holdings Incorporated, the broker's parent, had been Wall Street's fourth largest investment bank before filing what remains by far the largest U.S. bankruptcy on September 15, 2008. Its collapse led to much debate over whether and in what circumstances companies should be allowed to fail. Barclays plc bought up most of Lehman's U.S. brokerage assets early in the financial crisis. The parent's Chapter 11 bankruptcy plan was confirmed in 2011. So, yeah, the Barclays came in and bought up basically some office towers and stuff, some physical assets, but they didn't buy. There was no equity buyout. Finally, last thing, again from Reuters. So then if we fast forward, we'll see how long it actually took from September 15th, 2008 until everyone was kind of made whole. New York, September 28th, the liquidation of Leman Brothers' brokerage unit has ended 14 years and 13 days after its parents' bankruptcy helped trigger a market freefall and global financial crisis. U.S. bankruptcy judge Shelley Chapman in Manhattan closed the brokerage's estate on Wednesday and awarded final payments to the trustee who oversaw its liquidation and his law firm. More than $115 billion was paid out. Lehman's 111,000 customers received all $106 billion they were owed, and secured creditors also received full payouts. So this is actually different than what we hear from David Rogers Webb, because David Rogers Webb is really, really insistent that Leman was the kind of trial case, the thing that was needed to put into case law this situation where it was put into case law that the custodian basically could own or take ownership of the shares. And this lasted for like 14 years. This is one of David Rogers Webb's big points, is that this needed to be established in the courts. And so let's do the math. We know that from the caption, Leman Brothers failed 2008. The court didn't wrap all this up till 14 years later, so that would be, 2022, right? So this was not solidified until recently. So George Gammon, I like him, his YouTube channel, Rebel Capitalist and all that, but he really pokes at holes in David Rogers Webb's analysis, and he says, look, I mean, the 2020 lockdowns, it would have been the perfect time. And I think David's response would have said they weren't ready. Like, they didn't have case law in place. They were waiting for this. They're waiting for this to wrap up, and it didn't get wrapped up until the end of 2022. Okay, last stop, Merrill Lynch, bought out by Bank of America. Like I said before, if you look at this Frontline PBS special, you'll see, what is this guy's name? Ken Lewis. I think his name's Ken Lewis. He was the president at that time of Bank of America. He really wanted to buy Merrill Lynch for many, many years. When he saw his opportunity, he thought it was going to be awesome. It turned out not being so awesome. In fact, he tried to actually give it back or reverse the buyout, and the feds came in, and I think they gave him $20 billion the first time. They gave him another $20 billion the second time, and then they also put in some offer. Go check out the documentary of like an extra 100 and I think in the teens billion to cover any losses on mortgage-backed securities. So like we said, Merrill Lynch, this was, looks like you can see the 2007 was the drop down. This is from CNN Money. They had 841 billion in assets. It had a market valuation of 75 billion. So here we see the stock's 49% decline over the past year, / nearly 42 billion for Merrill's peak market capitalization of 84.7 billion in late January 2007. The start of a booming year for investment banking fees and big bets on subprime mortgages ended in dismal fashion. Yes, it did, Reuters. And then so again, you can just look at this documentary, Breaking the Bank. I mean, Ken Lewis basically says that he regrets getting involved with the Fed. There's people in there that say that through that whole bank bailout process is essentially the moment in American history. There was a pivotal change where the banks basically became nationalized or owned in part by the federal government. And David Rogers Webb, big point with the Great Taking is that the powers that be, or the masterminds, or whatever you want to call it, who is going to force like a huge, say, banking collapse, and then try to force everybody into some kind of like CBDC slavery by, joining the central bank digital currency program. Basically, They want to make sure that the banks aren't nationalized. That's why they can't depend upon a huge federal bailout package like TARP in 2007, 2008. They don't want the banks being owned like 80, 90% by the taxpayers, right? They want to instead, according to Webb's thesis, they want instead to be able to change the laws, basically capture all the money that's tied up in our shares, essentially take the shares from the normal people in some sort of crisis situation where it's ultra important that in order to save the system, this must simply be done, and that it's legal and it's going to be done, and otherwise, like, the entire American economy will collapse. And so, sorry everybody, but it's time to take one for the team, and also there's nothing you can do about it. I mean, that's really David's thesis. He doesn't explicitly say that he's a person of faith, but one of the reasons I said early on in this video that you have to kind of take David on faith is that, one, you don't understand the clearinghouses. I mean, you can read his book and you can get a basic conception of, that these are internationally transferable. You could. It seems very, very possible that you could get locked out of your accounts. I know people that happened to them in Lebanon, when Lebanon had basically a banking crisis, capital controls, whatever you want to call it. You're basically told how much of your money you can get. That happens. However, I would say we're not going to become experts at bankruptcy law. We're not going to become experts at what the Fed has said in regards to insolvencies of clearinghouses. David has provided us some things, some quotes, some documentation. Whether we can understand it 100% is sort of a different story. Whether what he's saying is reliable is a different story. You have to believe that it's sort of nefarious and that it's intentional, that this is sort of being hidden from people. So your financial advisor is not going to know about this. If you call the customer service line at, say, Vanguard, they're not going to know about this, right? They're not going to be informed about all the technicalities behind the clearinghouses and things like that. I mean, who would actually tell you the truth about this stuff? I think in the end, it almost takes a person to kind of come to terms with their worldview in terms of, what do you think about people? Do you think that people are generally evil? It seems that most of us have a tough time believing that. It's just an uncomfortable feeling to think that we can't trust anyone, that people are out to get us, that there's these evil geniuses that are eventually going to trick us or outsmart us or something like that, right? That the whole thing is a fraud, that we're in some huge bait and switch or some kind of huge Ponzi scheme. That's hard to kind of imagine that. So one other thing that might be interesting is if you go to the Great Taking YouTube channel, David Rogers Webb has a video of him and three other people giving testimony before a subcommittee in Tennessee about the dangers that we were talking about here, and a bill that was proposed in order to change some of the legal guidelines in Tennessee. There was two individuals that pushed back on it. One guy that seemed like totally bought and paid for, in my opinion. I mean, you could just almost get the sense of the lack of confidence in this individual who just read basically scripted just document for his testimony, and it was all the standard mumbo jumbo garbage crap backed up by conditional statements as far as he understood, right? Which wasn't very convincing. Another lawyer did give some decent testimony which said, hey, look, it's important to have a unified commercial code so that you can do business in all 50 states. You don't want to have a different legal code that governs every single state. That's a nightmare for anybody that wants to, sell online or, ship products across state lines. So that totally made sense. I think what was very clear to me about that is that David Rogers Webb is just trying to get as much face time and trying to get this out in the open. He knows that changing the laws just in Tennessee are not going to have the broad-reaching effects that he needs. He needs it to go all the way to the SEC. He needs it to be a Supreme Court type of issue, and I don't think he's going to get the hearing. What does that mean for us? That means basically, I've thought about it. Pulling, if you believe him, I mean, you either believe him or you don't. Right? So then what are we going to do, assuming that we believe David Rogers Webb analysis and that essentially all shareholders are at extreme risk for some kind of somewhat diabolical or at least pre-planned forced conversion of your average citizen into some kind of hyper-controlling central bank digital currency. Let's say you believe all that story, right? And then let's say that you believe that the legal framework has basically been built over the last few decades. You didn't know about it, and most of the people that are supposed to be protecting you are either don't know or are not ready to quit their jobs in order to essentially stand up to an industry that's gone awry. So now you're left with a free PDF book, a couple of podcast interviews, and a YouTube channel by some guy that apparently moved to Sweden in order to advocate to the Swedish finance minister that this was a big problem. And ultimately, I believe that he was told that Sweden was not going to be able to go it alone. If Germany went along with the United States and the rest of the EU, then there was nothing really Sweden could do. As far as we know, David and his family still live in Sweden. And what are you going to do? Well, if you really believe him, in my opinion, I mean, as I've thought about it, my situation, is this guy right? I mean, do I have enough to go on here to really go with this guy, that there's the framework is there, that the current nature is there, that it would take something like this in order to force everybody into the CBDC? It's like, okay, let's just say hypothetically I believed in him. What am I going to do? Well, I don't want to put a bunch of money into Bitcoin at all-time highs. I'm sure there's people that would be, disagreeing with me on that, but it's pretty volatile, right? I mean, if it goes from 70,000 a coin to, this is US dollars, down to 25 again, I mean, that's going to be a problem, especially if I have most of my money in at a cost per coin of 70,000, 68,000. I mean, if it goes up, great, but maybe that's not the point. I'm more looking for capital preservation is what I'm thinking. So I don't think I want to do that. Do I want to buy a business? Not particularly. I mean, most of the economists I know are saying, bad recession, massive levels of debt, and then obviously because just hypothetically, I believe, and I'm going to go with David Rogers Webb, there's going to be a huge market collapse. Markets are going to affect the real economy. I mean, David's best case scenario is that you kind of hunker down, you learn how to farm, you sort of focus in on skills related to real things, that there is like chairs and cars and you can buildings and fish and I don't know, all kinds of the material world type of stuff that really exists, and that people made it through the Great Depression, and his forefathers did, and it took a huge toll on Cleveland, where he seems to be almost traumatized, and that has been a big motivator in his life to understand what happened to Cleveland, what happened to his family members. You could buy real estate. I think if you could own real estate full out, in David's view, then that's a good play. There is some debate that a lot of people that have come across his content say, well, what if the bank owns half of my house and the bank goes bust? What happens there? So owning real estate property outright, which is not realistic for a lot of people, even if you can find a condo in your area for, say, $200,000, to be able to pay for any housing just full out cash without use of any debt is sort of long shot. Finally, the more difficult things would be to follow David in his footsteps and perhaps move abroad. So, I mean, David talks a lot that all 50 U.S. states have kind of under this problematic umbrella, as well as Europe. So he doesn't really mention much in his book that I found as far as what about Australia, what about New Zealand, what about Latin America. Then it becomes sort of a problem of culture, language, and your ability to find gainful employment in those markets. There may be legal restrictions to, employing foreigners as you would be or as I would be outside of where we have, work visas as citizens and things of that nature. You can go to certain places and buy work visas in the Middle East and things like that. But, it starts to get like really big time, baby, where if you're going to uproot your entire life and move to a different country just on the basis of David Webb's postulations, you better be pretty convinced that he is right. And honestly, I find his work to be really compelling. It seems not that unbelievable to me. The derivatives market is obviously huge. With banks, major institutions being levered up like they were in 2007, 2008. I mean, Lehman was the fourth largest investment bank in the United States. 60-year track record. Totally blows a huge hole right in the bottom of their boat, right? And they go down. And there's the contagion. So to wrap up, I thought about going through some of the visualization of the nominal value of the derivatives market. I say it's, like 2 quadrillion. So that would be, you have a trillion, and 1,000 trillion is a quadrillion. And they say they have 2 of those. So it's something like 20 times global GDP is wrapped up in the notional value of the derivatives market. It's just a bunch of big words. It basically means that there's a lot of volatility that exists, because as long as everything kind of goes as it did, as long as things are pretty peaceful, a lot of, I think, the derivatives contracts are going to finish out of the money, which means there's no big money changing hands in those events. It's when markets are really, really extreme, really wild, huge peaks and huge drops, where a lot of those derivatives contracts become worth a lot of money. It's not like we're expecting a huge, I guess David Hunter is, David Hunter is expecting a huge run up, which would be very explosive if there was a lot of derivatives and leverage behind that. And then he's predicting an 8% drop. So you have a huge spike, and then you have a huge fall off. Well, both of those would be probably cataclysmic. The type of cataclysmic event that David Rogers Webb would say would basically do in the current clearinghouses, the brokerages, and the custodians. So go back and look at this. Go back and look at this video, Breaking the Bank, PBS film, and tell me whether or not you feel like the Treasury was worried about a systemic collapse. So I'm telling you that they were. They made all the CEOs of the major banks, plus their more senior directors, come in on short notice as soon as Bear and Lehman and Merrill got in trouble, especially with the Merrill deal. Come in, take $20 billion each. The guy at Wells Fargo, the CEO of Wells Fargo, didn't even want the money. They're forced to take it. And then basically Bank of America was forced to buy Merrill Lynch. They were extremely concerned. They were extremely concerned of basically the U.S. economy totally locking up if the credit market stopped, froze, which is exactly what they describe in that video as happening, and which is why, and it's also why Bank of America was given a weekend, about 48 hours, from like Friday afternoon, late Friday afternoon till Sunday, to decide whether or not they were going to buy Merrill and how much they were going to pay for it. It's impossible. It's impossible to do that type of analysis on an institution like that with over $840 billion of assets. And they got it wrong. They overpaid for it and they try to give it back. So it's very easy, I think, if you look back at history, to make the case that the type of leverage and the size of the institutions, you add those things together and it doesn't equal safety. There can be huge problems. And I think for me, that's what makes David Rogers Webb's thesis extremely believable, because if the derivative market blows up and you've never heard of David Rogers Webb, what do you think happens? Right? Where do those bad assets go? Like, we have like hyperinflation and the U.S. government buys everything? I mean, what's the other solution? David Rogers Webb at least offers another solution that they confiscate everybody's securities to pay for it. I can't imagine. The only other guy I've heard talk about it is a very general statement from Jeffrey Gunlock at Double Line, who says that we're going to have a currency reset. Like, what does that mean? He doesn't even go into depth about, like, what does that mean? So, I don't know why. I don't know what it means, and I mean that's why it's depressing, because it doesn't leave you with a lot of options, and it also undermines your faith in a lot of what you're told, especially if you spent like years studying basically security investment banking, finance, and things of that nature. So that's kind of all I have for this one. Thanks for watching. I'm sure there'll probably be a follow-up because there's a lot left to cover on this topic, but that's probably more than enough for now. Thanks so much. Bye.